0.7% versus about 12.3% last year. The order inflow and the order book continues to remain very, very robust. We have Mr. R. Shankar Raman, the whole-time director and CFO of the company, joining in. Mr. Raman, always a pleasure talking to you. Thanks for joining in. So no one's disputing the order flows, right? I think your order book is almost touching 4 lakh crore rupees now. So that's a massive ship that's moving along. But I will start with the market's issue on the margin. And I'll tell you what, it's not just the fourth quarter, the quarter-on-quarter or the year-on-year slip in the fourth quarter, but the guidance you've given, 9%, EBITDA margin guidance. I think a lot of people are wondering why. I mean, is it hyper competition in these orders, or is it that you're anticipating commodity costs to remain elevated? Why so conservative on margins?
Yeah, let me deconstruct our margins to you so that there is clarity and less concern around as something is going wrong. Our costs has 2-3 elements. One is the big procurement cost, all the materials that we procure. And the second is the execution cost, the cost that we incur at the site. And third is the profits that we make on top of this. Much of the orders that we executed in FY23 was a result of the orders that we had accumulated in FY22 and towards the second half of FY21. Normally, the curing period for these orders to actual pickup of pace in execution is anywhere between 6 and 12 to 15 months, depending on the complexity of the project. The engineering takes bulk of the early part of the projects, and the actual physical work including procurement, installation, etc., happens in the second half of the project. So we have gone through FY23 as a period where much of the activity happened on the ground, and that is why you see the revenues have also scaled up by about 17% as compared to the previous year. The corollary to the scale up in the revenue has been the cost. The way we account for costs, and that's the right way to do any case, is that as the costs are incurred, they're accounted onto the project. And the reliefs that come in through conversations with the customers, etc., happens at the back end after the project is completed. When we had a situation in the last 15 months where raw material prices spiraled somewhere between 25 to 75% at various points in time. And this unfortunate war in Europe also spiked a lot of logistics. Orientation had to be changed, and the routes have to be changed, etc. The shipping cost and the logistics time constraints shot up. At the back end of all this was anyway the time that we lost in FY21 because of the COVID. We had to stay commissioned, but we couldn't actually physically work as much as we would have liked to on the project. And staying longer in a project site means the cost is incurred because the site is mobilized, the things are working in the site, but not producing milestones that can be invoiced. So one piece of the cost is overstay cost, waiting for the customer to recognize that we are caught in a site where we are not able to execute, so time extensions have to be negotiated and given. Time extensions are the easier part of the whole equation because clients do appreciate and give. But when it comes to reimbursing the cost of the extended time, that's where the negotiations begin. On top of it, if you have such spiraling material costs that are incurred, then the conversation becomes that much more heavy, and it actually escalates in the respective client organization to a much higher level because the lower people will not be able to take these kind of discretionary calls. So where we are at this situation is we are executing projects that we had committed to execute in later part of 21 and much of 22. This would continue up to maybe 3 quarters of 23-24 as well. My assessment is from the last quarter of 23-24 and then going forward 24-25, 25-26, we will start executing projects which have been collected during FY23. As you know, we won orders worth 231,000 crores in FY23. That's a big number. Now, those will get into execution mode in the last quarter of the current year and in the subsequent quarters of the following years. Now, those have been bid with reference to current prices. So the element of surprise, negative surprise that we had in the earlier orders are hopefully not present here. And you will find, let's just complete. You will find the margins nearing their normalcy in that period. The last quarter.
So what do you define as normal margins? So glad that you explained this very well to us. Fourth quarter of the current fiscal, you start, executing the newer projects that you've bid for. That's when margins start improving. So what do you describe as normal as we're looking at the end of the year then?
See, if you have to also step back a bit to understand our portfolio, because our margins are a summation of the services business that we run, the manufacturing business that we run, and the EPC business, the project business that we run. The project business margin profile would be around 9%, 9 to 9.5%, depending on the type of projects that we receive and the economics that play out. The manufacturing businesses would be all in mid-teens, and the services business would be around 19-20%. That's the mix. 1/3 of our revenues come from services today, and 2/3 come from manufacturing and projects. So the overall margin profile will depend on two things. One is the cost escalations that has got absorbed in the quarters that has gone past, receding as we complete those projects. And the new projects kick in with more normalized margins of 9.5%. So the mix will begin to change, and hopefully our thrust on services, if they continue and they continue to be as profitable, that also contributes to the overall margin. So my sense is that blended margins would be anywhere between 9 and 10% in a normal situation. And what we have lived through in FY22 and FY23 is clearly abnormal times.
Got it. So can we assume FY25 might be a more normal year for you when margins inch closer to that 10% mark? Because most of your high-cost projects, whether it's an account of higher raw materials or overstay, may get exhausted by Q3 of FY24 or even assume FY24. In FY25, can your margins hit, sir, closer to 10%?
That will be the trajectory. We recognize our margins in connection with the milestones that we achieve in the project. They are not linear. The project has to reach 25% completion for us to reach the first level of margin recognition, etc. And the margin recognition peaks after the project crosses 50%. And why are we doing this? The certainty of outcome improves as the project becomes closer and closer to its exit time. That's the reason why the margins are recognized back-ended. But I think it is fair to estimate that the stress that we have seen in project business is possibly behind us in FY23. The first 2-3 quarters of FY24 will continue to report soft margins, but I think we have to look at it in the context of the costs are getting incurred and washed out of the profit and loss account. The conversations with the client will start on settlements, reimbursements, etc. And those will begin to drip in over the next 12 months in various quarters, and that we will have to see as we go forward.
All right, got that. That is on the margins. But the big positive this time in the numbers is obviously the order book and the kind of inflows that you have seen. Mr. Raman, you saw around 76,000 crores in a single quarter in Q4. So I have to ask you what part of this is defense, because we have been talking about the defense orders really picking up across the board. So what is, just the defense order out of the 76,000? And also your order inflow guidance is very strong. So where are you seeing very high demand for FY24?
Yeah, out of the 76,000 crore, possibly about 8,000 odd crores is defense. Still, we do think it's modest, given the fact that the government definitely wants to promote domestic manufacturing, and the kind of work that we do as a company, hardly anybody does in the country. There are a few players engaged in defense manufacturing, but they're all in different segments of defense. So if the government persists with this policy of encouraging private sector to produce, manufacture defense equipments, I think we could look at better times ahead. But as we normally keep saying, the decision-making process in this is pretty labored, and consequently, the timing of these order inflows are yet not on the predictable zone. Talking about predictable orders, infrastructure sector has matured up to a stage where now certain amount of predictability is surfacing. We do look at FY24 as a year which has possibly 10 lakh crore worth of interesting prospects in terms of various projects. And if this 10 lakh crore worth of projects were to play out, then there is reasonable chance that we would get about 2 odd lakh crore out of that, which is a 20% win rate, which is our standard. Where does this 10 lakh crore come from? I think about, if I add up the programs that the government and the various state, central government, etc., have been talking about, including some private sector, we're talking about something like 6.5 lakh crore in the space of infrastructure itself. And these straddle between the buildings and factories, the power transmission distribution, the heavy civil work that we do, the transportation infrastructure work that we do, the minerals and metal space that we provide project services. All of this put together provides us this 6.5 lakh crore. Hydrocarbon, given that 1/3 of our revenues still come from international business and largely from Middle East, Middle East continues to spend a fair bit on hydrocarbon. The firm oil prices have encouraged them to carry on with their hydrocarbon investments. At the same time, they're also preparing for life after oil. So to that extent, we see a fair bit of traction in Middle East, particularly Saudi Arabia, on renewable power. Solar is a big thing happening in Saudi Arabia, and we are beneficiaries of some of these large projects that have come in from Saudi Arabia. The other parts of Middle East are also investing. And secondly, I think instead of just being oil exporting or a gas exporting set of countries, they're also looking at downstream application. We find them investing in refineries. We find them investing in connectivity. I think, as you know, the topography of Middle East is, cities far flung, and they're not connected very well other than by roads. Today, I think connectivity is something that they're working on. So all this provides us opportunities beyond just the oil and gas for us.
So just a small follow-up question. I'm so glad that you brought up renewables because, eventually hydrocarbon is a huge part of your book, and eventually, in a longer time frame, it will start moving to the green side, both on defense and renewables, because those are going to be the sunrise, or already are the sunrise sectors. What's the profitability? What are the margins that you're fetching right now on these two areas vis-a-vis, let's say, infrastructure? What type of orders are most profitable for you as of now?
See, I think energy transition generally is, people are still to figure out what is the cost economics and who's going to pay for this energy transition. It is not definitely going to be cheap to start with. I mean, if you roll back in your mind, solar was far more expensive 5 years before than what it is today. The solar modules were expensive, the technology was inaccessible and quite concentrated, available only in few pockets. Today, solar has become a little more competitive than what it was, thanks to the general trend down of prices and access to multiple technologies. Renewable and things like hydrogen is in that space now. It's very expensive. Like we used to pay 35 rupees per minute for mobile telephone calls 20 years ago. I think the cost of transiting, ducking the existing technology and for energy and moving to renewable, especially hydrogen, is going to be a 3 to 5 year discovery process. What we are trying to do is to stay relevant. We are tracking what is changing. We are trying to talk to customers, especially those who are actually emitting a lot of carbon today in their base industries. We are talking to them to understand what is their plan. Our idea is to be a service provider for the construction, project management, and maybe supply a few critical equipments. It is with that in mind that we have got into electrolyzer manufacturing. We have tied up a few months ago with McPhy of France on technology. The idea is to manufacture electrolyzer in Gujarat, in one of our existing facilities. We do believe that electrolyzer is a very important component in splitting water for hydrogen. And I think we have, hopefully, in us a product which is a global product. But we need to get the technology absorption right. So the focus is initially to roll out by the end of the current year a few of the electrolyzers, which can be prototypes, and then thereafter work on the market to see how the cost economics play out. But it's a very interesting space. I'm not sure whether the retail consumers will start using hydrogen as an alternate fuel in the immediate future. But I think we'll start with long distance transportation and maybe follow it up with industrial, and then it will come into consumer.
Mr. Raman, just one final question, and I'm squeezing in some three of them here. Are you on track to achieve your Lakshya 26 guidance of doubling your revenues and order inflows? Any tweaks to that, big milestone that you want to achieve? 2, buyback plans, and 3, any thoughts on, AM Naik and the kind of contribution that he's had to L&T?
Sure. I think glad to tell you that we are absolutely on spot as far as Lakshya is concerned. We just completed 2 years and 3 more years to go before the plan plays out. As at the end of the second year, we are bang on where we wanted to be. So there is every reason for us to believe that we would be working on this plan to double the revenue between FY21 and FY26. So I think we are on course. The fact that we have been able to win orders encourages us to believe that we are pursuing the right opportunities with right competitiveness. So both in terms of order inflow as well as revenue, I think we would be on track. The big question, of course, is what we started the conversation with: how profitable is going to be this revenue? We are doing all our best to make sure that we stay competitive, because you must realize that bulk of our business comes based on tendered projects, and L1 rules the winners there. So consequently, there is very little leeway that we have on determining the end price. What we have within our control is cost management and cash flow management. We are trying to pay a lot of attention to these two to see how we can stay competitive so that the profit targets that we have set for ourselves will happen. The measure of value creation that we have given Lakshya 26 is ROE. We started FY21 with 9% ROE. We wanted to end 26 with 18% ROE, and we are at about 12.2% as we close 23. And we hope to get to around 14% or thereabouts by the time we close 24. And that would leave us the last slog overs to get to 18. Now, part of this would be 2-3 strategies. One is to exit businesses which are asset heavy and back-ended in returns. So they will eliminate the losses that are today featuring in our profit and loss account. 2, they will release cash to be able to ensure that we manage our working capital well. 3, the efficiency with which we have managed our working capital, if you continue through the plan period, we are likely to have a lot of cash generated in this period. And we do not have large investment plans that we have. Any inorganic acquisition is mostly in the technology space of IT, technology services, etc. And those are separate listed subsidiaries which will have their own acquisition plans. So as far as L&T is concerned, it looks to the next 3 years as a fairly good period to gather a large pool of cash. Now, what do we do with this cash? We have stepped up our dividend payout ratio to 43% in FY23. We were at 26% normally. So one is stepped up dividend. Second is we had in the past applied to the regulators for approval for buyback, and the regulatory norms did not permit at that point in time. We do believe in the next 3-year period, the regulations do permit our candidature. So we need to work out a plan to do that. The whole idea is in the next 3 years, we're not going to keep more cash than what we require in our business. The cash that we generate are for shareholders, and we will try to find the most tax optimal way in sharing the good fortunes that we hopefully will experience. Coming finally to Mr. Naik, it's very difficult to imagine life without him, because all of us have been in the system, seeing him and using him as a role model for all that he has done for the company. And I think it will be very difficult to take L&T out of Mr. Naik. Of course, he has ceded all the executive responsibilities a few years ago. He is also stepping out of the board as chairman, non-executive chairman, come October 1st. So I think my colleague and CEO, MD, Mr. Subramaniam, has a big shoe to fill. And I think we are all there to support, to make sure that, the legacy continues. Of course, Mr. Naik would be available for any one of us for any form of consultation. And I think being the well-wisher that he is of L&T and the shareholders of L&T, I think we would take advantage of that to the extent we can.
Absolutely, Mr. Raman. It's been a pleasure speaking with you. And I think, Mr. Naik, we'll all agree that he has been the torchbearer and really the face of pushing forward for infrastructure growth in this country for many, many decades. Pleasure talking to you. Thank you very much for making time. We will take a quick break on that note. More on the markets in just a bit.